Tony Dragicevich, the CEO at Capral Aluminium, Australia's largest manufacturer and distributor of aluminium products. Our core business is the manufacture of aluminium extrusions produced in 6 manufacturing plants located in all the mainland states of Australia. 2/3 of our volume is sold directly from our plants to large customers, with the other 1/3 of our volume going through our own distribution centres, which we have nationally right around Australia.
Brilliant. Tony, lovely to meet you. And thanks for coming on the show. Going to learn a little bit about your company today, Capral. But I'm going to take it back a little bit, if you don't mind, because it's a space I don't think many people necessarily have done a lot of work trying to understand. So tell us a little bit about the products that you have and the products that you create and sell, first of all, just to understand that.
Okay, so we produce aluminium extrusions. We buy billet from mainly Australian smelters. We extrude that through what we call extrusion presses, so around 3,000 tonne capacity. We push the extrusion through a die and manufacture every month around 3,000 or 4,000 different extrusion shapes. Those extrusions go into the manufacture of things like windows and doors, particularly it's our biggest single market, but also into building truck bodies and boats,
right,
things like that.
And what are the, you were 3,000 or 4,000 of the KPIs there? So what are the main ones? What are the ones that comprise the bulk of your revenue?
The bulk of our revenue is extrusions that we sell to window and door manufacturers, and they produce window systems out of them.
Got it. So the property boom in Australia is helping you at the moment, I suspect.
Absolutely.
Got it. Okay.
Absolutely.
But you do things in terms of in the transport sector as well, but that's a smaller portion of your revenue.
Yes. So the construction industry, both residential and commercial, generates around 60% of our volume, and 40% of our volume goes into a wide range of industrial applications. The 2 largest are truck building and boat building.
Got it, understood. So we sort of know, I just want everyone as a picture of the sorts of products that you create, first of all. So let's go back a bit, okay? If I look back from 17 through to 19, fairly flat, if anything, slightly downward movement in your share price, but COVID came along and you seem to have reacted quite well as a company to that, or taken advantage of that situation, despite, I saw a statement from you saying, impacted, operations impacted by COVID. Is the behaviours of people in Australia, consumers, retail, housing sector, government, has that driven it, or is it something that you've done?
Look, there's a number of things that have impacted upon our turnaround in earnings. First of all, we undertook a significant lift, significant restructure of our manufacturing operations in Queensland, which is our biggest plant. But there's no doubt that coming out of COVID, with government stimulating the economy, particularly in the housing sector, but also in infrastructure, we've seen a lift in demand for our products. Yeah, and through that period of COVID times, import supply chains were disrupted. Now, imports make up 1/3 of our market, so we compete against one, which is a significant proportion of the market. Supply chain disruption, I guess, more Australian-made sentiment as customers wanted to buy local to support the Australian economy, but also with shorter supply chains, and now, as we see today, significantly increased international freight rates has made local manufacturers very competitive sustainably against imports.
Okay, well, let's come back to that, because I think that's important. But you mentioned something there which intrigued me. You did a restructure in 2019-ish. Why did you feel you needed to do that? What did it cost you, and what did you restructure it to?
Look, all of our manufacturing plants, apart from our big plant up at Bremer Park in Queensland, make money right through the cycle. But that plant is our largest single plant. It had 4 extrusion presses, 2 paint lines, and a big anodizing plant in that site, a very big site. All of our other plants are single press plants. This was the big behemoth. We built it around 17 years ago, and it struggled to make money through that period. So the restructure we undertook in 2019 was well and truly overdue. The reason that it took us so long to do it was because we were locked into a 20-year lease on that site. But with that lease coming to close to its end of its life, we were able to renegotiate the lease, sublet part of the building, closed down the unprofitable parts of that site and that operation. We spent around $7.5 to $8 million in terms of redundancy and restructuring costs. Plus, we spent around $3 or $4 million on automating all the packaging in that plant. So that's been a significant turnaround for the business. It's taken in excess of $8 million worth of fixed cost out of the plant. And with the automation we put into the plant, it's also made the plant more efficient running.
Did you borrow money to do all of that?
No, we did out of cash flow.
Okay. And how is cash flow today? Well, how's your cash position today, and what is cash flow?
We've run net cash positive for the last 4 or 5 years. And certainly our cash position at the end of our last financial year, December, was around 40 odd million. We made an acquisition of a competitor's extrusion plant earlier this year, so that cost us around about 12 million. But we always aim to run cash positive.
Right. Okay. So any more acquisitions coming through? Because I noticed in the presentation you're talking about having about a quarter of the market as it stands. And obviously you're going to want to come and tell me about a growth story today. So is that going to come through acquisition, organic, or indeed, as you mentioned earlier, is the fact that, cost of imports is significantly being increased by, lots of factors. Where's it coming from? Look,
certainly we think that there's been a strategic, a real shift in the market in terms of moving away from imports and a higher proportion to local supply for all the factors that I've just mentioned. But we're also looking at acquisition opportunities. One of those came along late last year, and we finalised that deal in February. So we acquired a plant in Sydney off one of our local competitors who had put more capacity. They're a Queensland-based company, and they invested in more capacity into Queensland. So this opportunity came up, and we're able to acquire that plant for around about 30% of its replacement cost. So look, our focus at the moment is getting that plant up and running to full capacity, which will generate further profitability for the business going forward. So that's strategically really important to have that additional plant based in Sydney, which is our largest market. So that now gives us 2 presses in New South Wales, which is very important.
Okay, so you've got the capacity. We better talk, which is obviously the supply component. We better talk about the demand element. You said the Australian government is obviously incentivizing state by state as well. New builds. There's a lot of new builds. I think through COVID, people are also deciding not to move around so much. They're upgrading their houses. They're also doing a lot of work there. So is that the property bit aspect you said is a significant portion of the revenue? Is that sustainable? Is that going to see is the next 5 years look the same, or are you just taking it year by year on that front?
Look, it's there's no doubt that the housing market is the most variable of the markets we play. Housing market goes up and down, as we know, and we are heading towards a peak. The amount of work that's in the system at the moment will take us right through until the end of 2022 at least. There's so much work for builders to complete. Their order books are full. The market is extremely buoyant. And so we are expecting that housing market, level of housing market and the work in that pipeline to continue right for the next 12 to 18 months. The market will taper off after that. But the other parts of our business, which rely on the industrial sectors, are pretty steady, and they grow at in line with GDP growth, 2-3% per annum. Plus, the government is also spending on infrastructure at the moment as well. So, when you build new roads, you need trucks to transport material. When you're putting in new airports, like we are in Sydney, there's structure, there's transport and infrastructure around that. So we see the demand outlook, strong for the next 2 to 3 years at least.
Okay, so when companies do well, like I say, you had a kind of flat period there for a while. You're sitting on some cash, and you like to run cash flow positive, which is great. It's a nice conservative approach to this. But when companies start to do well, especially in these bull markets, the decision making changes somewhat. They start talking about dividends when they've never paid dividends before. They start talking about growth profiles which they just can't control. So how do you future-proof your company in terms of the way that you approach, delivering the business for your shareholders and obviously your employees and the board?
Look, the key things that we're concentrating on, look, from our major objective is to be a regular dividend payer and be a high-yield stock. We resumed paying dividends around 3 years ago after the restructure, and we're continuing to pay dividends. We've got franking credits on our balance sheet, franking credits available to us, which we will continue to pay.
Tell me about those, if you don't mind.
So we have Capral underwent. It's a bit of a long story, so just bear with me a second. So we're in a unique position where Capral has around $300 million worth of tax losses for losses which were generated going back into 10, 12 years ago when the Bremer plant was being commissioned. Those tax losses mean that we won't be paying company tax for many, many years ahead of us. In addition to that, we also have franking credits as a result of earnings earned prior to that period. So all the dividends we're paying and will be paying for the next 3 to 4 years will be fully franked, even though we're not currently paying tax. So that makes our dividend position very attractive. And people ask us, well, you've got excess cash, why don't you return capital? Well, the best thing we can do for our shareholders is to pay fully franked dividends, which we'll continue to do. And we want to continue to be a good profit generator, a sustainable profit generator with good dividend stream behind it. In terms of growing the business going forward, we've just made an acquisition of a competitor in Sydney, but there are other opportunities out. We have around 5 other significant, typically state-based competitors locally. Those businesses are private companies with ownership that is some of them nearing retirement, and those discussions have begun. And we won't say we're confident, but there's certainly opportunities out there for acquisitions and to, I guess, reorganize and restructure the market, in the years ahead.
Are you a target?
That's not only in terms of the extrusion manufacturing, but also the opportunity to buy downstream aluminium distribution businesses.
Which I want to come to. Are you a target?
Look, we were a target by private equity earlier this year. So one of the eminent private equity firms in Sydney or in Australia saw an opportunity that we were undervalued. They made a bid for Capral, which we put in front of our shareholders at $7 a share. Our major shareholders, pretty much rejected it outright as being undervaluing the business. But given that our share price had been trading sort of around the $4 to $4.50 mark, the board felt it was the right thing to do to put that offer in front of shareholders. But our major single shareholder is Alan Gray. They own around 20% equity in the business, and they were quite adamant that this was a $10 plus share and that we shouldn't be giving it away at this time. Right. So close to,
but it marks you as a potential takeover target. So I guess
potentially
shareholders will be factoring that into how they value you as well. Okay, so that's the kind of the sort of M&A component. What about? I know you've got 3,000 or 4,000 product lines potentially, in terms of extrusion products, but. Some of those are going to be de minimis. I mean, I guess you get a massive drop off after the first 100 product KPIs. Is that about right? Is that fair to say?
No. Well, see. I think one of the what we need to understand is that we don't actually produce an end product. We don't produce windows. We don't produce truck body.
Yeah.
We're an intermediary. So we produce 6 meter lengths in the main of aluminium extrusions, which we supply people that fabricate windows or build trucks or build boats.
Understood.
So, we don't have that tail off of customers. So our customers, to build our major window customers, to build the suite of windows that they sell to builders, they will have around 400 to 500 different extrusions to make up their suite of windows.
From you.
So and some of those will be high volume and some of them will be low volume. So it's
but they need all of the above. Right. They need all of the above. Okay.
Yeah.
Right. Yeah. Understood. Thank you for clarifying that. With regards to potential for you to move into different areas, new revenue streams that you're not in at the moment. Yes, through M&A, but you could also organically grow some of those if you saw markets and you felt that the expenditure would be worth the while. So, how do you look at growing organically?
I think growing organically for us really is growing our own distribution business. So currently around a third of our volume goes through our own distribution channel to our small to medium customers. And part of that business is that we supply Capral designed window systems to smaller residential window fabricators to service the smaller builders, and also the commercial window fabricators. So we have our own design system. There's a real opportunity. At the moment, we would have around 20% share of that market, and there's a real opportunity to grow that part of the business and grow our own distribution channel, which is far higher margin than selling to our major customers directly, out of our manufacturing plants. So that's really the focus in our business. We need the volume through our plants with our large customers to being a manufacturing business, and it's relatively low margin. But when we get the volume through our plants, we make good money, as we're currently doing. But really, in the medium to longer term, organically, we want to grow our own distribution business, and we've got some real opportunities to do that.
So tell me about that, because that's a really interesting one for businesses when they try to do that, because they've got to go. There's a cost of sale, increased cost of sale, obviously.
Yes.
But you're capturing significantly more of the downstream margin, as it were. So what is the trade-off there for you? I mean, what size does the market need to be for you to be interested in doing something like that?
Look, that market is a large market in Australia. The markets that we're talking about, and highly profitable. We already have the structure in place, because we're already servicing smaller industrial companies through our distribution business, and we're also already servicing the smaller window and door fabricators there. So that structure is already in place and has been for some time, but it hasn't been our primary focus. Our primary focus over the last 8 years since I've been with Capral is getting our manufacturing operations profitable, because that's where the real challenge has been. But now that we've been through that restructure, we've got all our plants generating good profits and good volumes. Our focus in the last 3 years has been on growing our distribution business so that we take more control over our own destiny and pick up more of that value add in that stream.
Okay, so you're focusing on efficiencies, the operating efficiencies, and obviously the Queensland 2019 rebuild and reorganization was a big part of that. But where's the meaningful growth come from? So you can get efficiency, you can tighten up and get margin on operating level, but there's got to be like real meaningful growth for shareholders like to see the growth stories, and the share price, like say from beginning of 2020 to the beginning of COVID, has really moved. A lot of things moving in your favor, but you're describing lots of small components which are adding up to the sum of the parts, as it were. But is there a kind of big move from you guys? We like to talk. We're pretty straight talkers in Capral. We've been around a long time, and we've been through the highs and lows. And so look, I don't want to overstate it, but the real key thing for us, our profitability at the moment, because our plants are running at close to capacity. So the acquisition of this new plant is going to give us around about an additional 20% capacity. If we can get the volume through that plant, the profitability of the business, at $30+ million EBITA levels is significant. And currently we're trading in a PE of less than 5. So, if we can continue just to do what we're doing, there is significant value in Capral, let alone the opportunities for growth. Now, look, the real opportunities for growth will come around, rationalization of competitors within the market. We're only 26% of that market. We've got the opportunity to grow. The real beauty of that is if the right acquisition opportunity comes up, because we've got $300 million worth of tax losses, if we acquire a aluminium business in the same business, the earnings of those businesses that we acquire are also tax-free. So we won't be paying, company tax on those earnings for many years to come as well. So that gives us the opportunity to pay an appropriate price for any acquisition opportunities as they come about. And also, as I say, those earnings will flow to the bottom line on a tax-free basis, which will be, significant value to shareholders in the years ahead. Right. So acquisition by you is more meaningful for sure. Okay. So, well, that's how partially explains it. Can you talk about some of the competition? Because there's if a third of it's coming from abroad, presumably,
yes.
Is there a lot of that China mostly?
Most China and Southeast Asia, but China's the largest. Yes.
Right. So they're presumably, you're going to see them sort of come back at some point. You expect them to come back at some point and be competitive again, do you? Or do you think that this is, with the cost of shipping, with the cost of, freight, etc., it's all just too much for them and they'll look elsewhere?
Look, the imports will always be part of our market. They've been here for some time. It's Australia's a high cost labour environment for manufacturing. So with the common geometric shapes that are easy to produce in big volumes, China or Southeast Asia will always play a part. The supply, the international freight rates are here to stay for at least another 12 months. But we believe there's also been a paradigm shift in people wanting to buy local. We've certainly seen that coming out of COVID. And, additionally, we're starting to see, that as our volumes go through our plants, that our cost base is very competitive, that the cost of aluminium in China is increasing as China is moving to. One of the advantages that China's had over us in Australia is that we buy metal at the global price of aluminium. And everywhere apart from China buys aluminium based on the LME. China is able to supply its downstream extrusion businesses that we compete against at an aluminium price that's below the world price. That's changed, and that's changed significantly. We actually have anti-dumping protection in place against China and against a couple of other Southeast Asian countries like Vietnam and Malaysia, and they've been in place for some time, and they will continue for another 5 years. And that keeps the real low cost damaging dumped imports out of the market. So that's all happened in the last few years. So I believe that the imports are under control, that the dump pricing is gone out of the market, and that we can continue to run good volumes through our plants, particularly with the new plant coming on board in Sydney, which will see our profitability, stay or increase from the levels it currently is with,
That's really interesting. So with those anti-dumping protections in place, that's great. That really helps you. So I always come back to the China question. At some point, people forget the buy Australia or buy local thing, and they go buy cheap. I need to make margin. My business needs to make margin. Do you expect? And there's always ways around the system, as it were. Do you think that the Chinese factor will come back in and be a player in Australia again at some point? Like, I get everything you've just said, but in terms of how you protect your business, de-risk your business, you've got to assume things like that could happen. Do you expect something to come along in terms of pricing's high at the moment, but it may drop off again? So what do you do in those circumstances? How do you adjust your business?
Look, we've been dealing with Chinese imports for well over a decade, probably 15 years at low cost. The work we've done on the anti-dumping front over the past 7 or 8 years has been not game changing, but it certainly kept the worst of it out. As that's that has stabilized the price. We're no longer seeing product coming in at really cheap prices, which is undermining the market. And we don't think that I'm pretty confident that's not going to happen for the foreseeable future, particularly as China is now starting to reduce and curtail its aluminium production capacity and smelting capacity in China in response to environmental impacts of greenhouse, reducing carbon emissions. So one of the reasons why the LME price of aluminium has escalated so much this year has been the announcement of China curtailing capacity. So I think there's been a fundamental shift. Not only do we have anti-dumping measures in place, which give us a level of protection to keep the worst of it out, but there's also been a fundamental shift in terms of excess aluminium being produced in China itself in response to the environmental situation worldwide.
Okay, and sort of question which spins off of the buy Australia or buy local thing, which is how do you sell? I mean, what does a contract look like? Are they people just stock up because you're an intermediary? Do they just stock up once a month, once a quarter, or do you have longer term contracts in place?
Look, with our very large customers, we have annual contracts in place, but really they're ordering off us weekly. So they'll typically place an order for a week, and we would supply it within depending on the customer or their demands, but typically within 2 weeks in a manufacturing plant. So our distributor customers, we make lead times a little bit longer, but typically we're supplying all our major, end user fabricators within 2 weeks of order.
Okay.
But our large ones, we will have a contract in place and pricing in place based on a fixed spread above LME for 12 months.
Right. Okay. So the supply is sort of just in time, but you do have longer. But have those contracts grown in length during this COVID period as a result of all the things that
we've been able to put more of them in place, put it that way.
Okay.
Yes.
So it gives you more long-term planning and certainty of your revenue.
We've had certainly given the disruptions, coming out of COVID, the market, I guess, booming quite quickly, and the supply chain difficulties, a number of customers that we haven't dealt with before, or we've had a small percentage of their business, have come to us for supply. So we've ramped up the capacity in our plants to pretty much full capacity, apart from the one we've just acquired, which we're getting up to. And we've been in a position to help them out. As a part of that helping them out has been that we've asked them to, sign up for a 12-month agreement to take a minimum offtake. And we've never been in that position before. So that's also been a fundamental change.
Did you find it
interesting? We haven't taken advantage of price. We're supplying at a competitive price to those customers because we want to retain them for the longer term.
Did you find it surprising that someone, a private equity company would make a bid for you guys? I mean, it's a small market. It suggests that they think there's potential for a roll-up, which means it suggests there's potential for you guys to, with your M&A, I know we talked about at the beginning, to target some other companies to kind of capture the Aussie market, because there's not too many players, are there? I mean, how many other players like you are there local?
We've five extrusion competitors of scale. They're typically, they're all regionally based. We're the only national, with the national footprint. And yes, there is opportunities within that extrusion manufacturing realm to make acquisitions.
Okay, so can you just...
And we're now in a position to be able to do that.
Right, okay, you put yourself in a position to do that. Can you just kind of run through your financials for me at the moment? Because I'm sort of looking at them here, and what I'm trying to work out, are you one big market correction away from trouble, or one big acquisition away from trouble, or is it actually this has been set up to allow you to, as you say, go through a process of maybe picking up one or two of the competitors?
Look, I think that where we're sitting with our financials is, we've certainly had very good, results in the last 18 months as we've come out of COVID lockdown in June last year, despite the challenges we're currently facing in Sydney and Melbourne. Demand is still strong, and our plants have continued to run. We've been up running, pretty much close to capacity since June last year. On that basis, we're going to produce. We've already given guidance out there, a trading EBITDA number of around 33 million for this year. Where our market capitalization is relatively low. We're trading on this year that translates into a PE of less than 5, as I said earlier. And our dividend, fully franked dividend yield will be quite attractive. Certainly one of the most attractive on the ASX, I would have thought. So look, we think that we're in a really solid financial position. We've worked really hard to get here. The restructure we undertook in 2019 was a game changer for us. So look, we're confident that the demand in the market over the next couple of years is there. We've worked really hard on making our plants more efficient and more competitive, and we work very hard on grabbing new customers and taking advantage of the opportunity that's been presented to us in the last 12 months to secure those customers for the longer term. In terms of growth down the track, as I said earlier, the focus in the business is in growing, in that high margin distribution business organically, which we have a really great opportunity to do, and we've been working on that steadily for the last 2 to 3 years. And plus, we've got opportunities for acquisition, which will probably come up in the next year or two.
Have you got your own proprietary software in terms of, obviously selling to your customers and so forth? Do you own that?
Yes, we do. We have, with our Windows system customers, the Capral who build the Capral windows and doors, we provide them with the software in which to put all those doors together and do all the quotations out of those systems. Yeah.
Okay, interesting. So I was just wondering where was there any more work going to be done on that, and how sophisticated is that in terms of some of the things you've talked about in terms of potentially moving downstream and design and so forth?
Yeah, well, we have we spent the last 2 to 3 years. Once we got our manufacturing businesses sorted out, we've spent a lot of work on product development in our own window and door systems, particularly in the residential windows and doors, and also new commercial products to market as well. And supporting all of that is a completely new software program which will help our fabricators put all those systems together in a really efficient way, right from ordering through that system and directly into Capral's SAP ERP system, right through to supply and help them fabricate those windows.
Would this ever go all the way down to retail? I know you're not at the moment, I appreciate that, but do you know what I mean? If you're talking about design and it's to help fabricators put it together, would you ever consider or contemplate your company fabricating some of these products and selling them to retail?
We have had the opportunity to actually make downstream acquisition of window fabricators over the last 8 years that I've been here. The challenge that we have is we don't have any expertise in that, number one, and secondly, we would compete with our largest customers, which would be the best way to lose a lot of volume at the end of the day. So no, we won't be going down that far downstream.
Okay. Well, look, Tony, really, really interesting. I'd not looked at this sort of business before. It's kind of interesting, and as you say, it's not too many players in the market. So it's interesting to see how you play it over the next 12, 24 months in terms of your growing share of the market. So I appreciate your time today. You should stay in touch.
Yeah, thanks, Matt. It's been really good talking. Look, I just leave a couple of key messages for everybody. Look, I really believe that this company has turned the corner. Our earnings are strong and will be for the next few years. We've got some great opportunities in terms of organic growth through our own systems business and distribution business, but also potential acquisition opportunities, not the least of which is we do have over $300 million worth of tax losses, which puts us into a really good position to make those acquisitions and take those earnings from those businesses tax-free into our shareholders' hands. So thanks, Matt, once again.